I want to show you a comparison of the California and BC tax rates. This is the percentage tax rates, and here's our dollars here. So, you know, the top rate in BC is 54%. The top rate in California is 57%. You say, oh, gee, it feels great to think we're taxed less in Canada than in the US. But that's a little bit deceiving, because you hit that top rate of 54% in BC at about Canadian $200,000. So your tax rates go up like that and stay like that. In the US, in California, you hit the top rate of 57% at $1 million US, or about 1.25 million Canadian. So somewhere over here, you hit that top rate. And yes, if you're LeBron James and you're making $20 million a year, you're over in this category. But most of us are somewhere in here. You can see there's a huge difference between the tax rate structure, even where tax rates are comparable. So that's a significant advantage still to the US, even in a high tax state like California. We talk about states like Washington and Texas and Nevada. You can choose if you want to live in Wyoming and Alaska. I mean, they have no tax rates, no personal income tax, those states. They have other taxes, but there's still, US personal tax rates are still far lower than they are in Canada. Let's flip to our next slide there. Okay. So the first thing we're going to talk about is US federal income tax, and our focus is on Canadians doing business in the US. First thing is, any person can do business in the US. You don't have to have a US corporation. You don't have to have a US entity. You can do business as a Canadian corporation in the US. You can do business as a German partnership in the US. You can do business in the US as a Zimbabwe. I don't know all the entities they have in Zimbabwe, but so it's not who you are that allows you to do business in the US. Any person can do business in the US. There may be choices you'd prefer or not prefer, but that doesn't restrict you from doing business. And the second thing is, absent the treaty, and we're going to talk about that in a moment, any US business activity in the US would be subject to tax. Now, Canada has a special relationship with the US, and about 50, I think it's about 56 or 58 other countries that have tax treaties with the US. So if you're from a non-treaty country, and a non-treaty country in the US would kind of lose track of the ones, but probably Zimbabwe. I don't know if Zimbabwe actually has a tax treaty with the US.
Latin America?
Lots of Latin America doesn't have tax treaties, that's true. So any US business activity triggers tax, but if you're from a treaty country like Canada, the US federally can only tax you if there's something called a permanent establishment there. So you'll only pay US federal income tax if there's a permanent establishment. Now, the next question is, what's this thing called a permanent establishment? And like a lot of things in life, the name's a little bit deceiving as to what a permanent establishment is. Usually think of it as bricks and mortar, because that sounds permanent, that sounds like an establishment. But the treaty defines it as firstly saying it's a fixed place of business. Now, again, that sounds like that bricks and mortar category, and that kind of makes sense, I think, if you're a store. But as we've been demonstrated in the last 12 months here, is a lot of people don't go to stores anymore. So, that would lose a whole part of the kind of the electronic commerce out there if there wasn't some provisions associated with that. So the term perm establishment has been expanded. This is not just in the last year. This is over the last years. It's saying, for example, a dependent agent that concludes contracts. That could include a contractor, but certainly employees when they conclude contracts. In other words, enter into binding contracts that bind some sell.
Yeah. In terms of like an actual example, what have you often seen in the past that kind of fits into that category?
Well, I use the example that only me and a few other people know about, and those are for people over 60 would know the Fuller Brushman, because it used to be that guys would walk through neighborhoods with a basket of brushes, and they'd turn up at your door and they'd sell brushes to people, and they'd conclude the contract there. But it would also include, an example is I've worked with before, is where someone was selling a certain product and they went down to places in the U.S. and they agreed to the terms of the deal in the U.S. and they signed the contract in the U.S. Now, the product wasn't delivered at that point in time, but a contract had been concluded. And therefore, there's a permanent establishment created as long as there's something called habitual exercise of the authority to conclude contracts. So concluding one contract's not an issue, but concluding multiple contracts is. And the one easy way to get around, they say, is we'll sign the contract outside the U.S. But I also caution people saying it's not good enough just to sign the contract outside the U.S. You actually need to do something substantive outside the U.S. Like running across the border and signing the contract implies that the contract may have already existed. So, but if you went back to Canada and said, I've got to schedule my inventory to be able to deliver this, I got to check with other people, see if I can, meet the terms of that contract, and then credit checks, yeah. Yep. All those things people don't really talk much about Dun and Bradstreet, but that's probably like the Fuller Brushman again. Yeah. is you need to do something substantive outside the country to avoid it being a contract concluded in the U.S. But if you do conclude contracts in the U.S., even though you don't have bricks and mortar, you'd have a permanent establishment.
And I would say one other example that doesn't necessarily come to mind quickly is you could have a property manager, for example, who could be a dependent agent who does stuff. So it's quite flexible in terms of the IRS could apply it to many different fact patterns, but the sales is the big one, obviously.
Right. Well, that's a great example, like the property manager. When you delegate authority to people to conclude contracts, that property manager might be buying services on behalf of the property, might be, buying insurance, other things they're buying for the property, or signing leases and things like that. Those things could all create concluded contracts in the U.S. Now, one of the newer provisions is the services permanent establishment. Again, we're getting way a ways from the whole idea of a bricks and mortar. And the services one says that if you spend more than 182 days in the U.S. in any 12-month period, so this is not 182 days in a calendar year, this is any 12 months, you could have a permanent establishment. Now, there's a couple different branches of this, and one is for kind of I'm going to call it the sole proprietor or the smaller business. And secondly is for larger business where they have multiple people going to the U.S. So this is one you need to be careful of if you're in the services business, is looking at situations that could trigger a services permanent establishment.
And you said you have seen this in your experience. I've not seen it in mine. But again, it depends on who your client is and kind of the facts.
Well, the typical thing that happens is where people say, I make sure, they say, I don't spend more than 182 days of the year in any calendar year. But they forget the test is any 12 months. So if I spend from, August to December in the U.S., and then from January to April in the U.S., I'm way over the 182 days in a 12-month period, even though I'm not 182 days in a calendar year. And this is, it can almost be kind of like the traveling salesman sort of situation, or let's say the IT professional. That's a really common situation. IT professionals going down to the U.S. and they provide services. But I've also seen it people involved with, oil and gas drilling sites and things like that. We'll spend extended stays in the U.S. and they can create a permanent establishment in that respect. And remember, permanent establishment, if you have a permanent establishment in the U.S., your business activity will be subject to U.S. federal income tax. Now, there are special rules associated with natural resources, construction, installation as well. So the takeaway here is there's U.S. tax only if there's a permanent establishment in the U.S.
And it might be worth mentioning too that there's certain things that are clearly not permanent establishment activities. So like having a warehouse, merely having inventory in the U.S., having a truly independent agent acting on your behalf.
What's a truly independent agent?
That's always a great question. It's facts and circumstances, obviously, and there's a bit of an analysis. But
so if you had someone, an agent who's acting on your behalf, but they've got 20 other clients and you only do a little bit of their business, they might not be an independent agent if all their business is with you. But they'd be independent if only a fraction of their business is with you. Yeah. Okay. So now people think, gee, I don't have a permanent establishment. I don't have to pay U.S. federal income tax. But it doesn't mean you don't have to file a tax return. If you don't have a permanent establishment, but you have business activity in the U.S., you should be filing a protective return, also called a treaty disclosure return. That's important, and we'll discuss that in just a moment.
I've had a lot of clients ask me, are you at a higher risk of audit if you file a protective return? What's your response?
No. One of my favorite movies is Raiders of the Lost Ark, and I love the scene in Raiders of the Lost Ark after they've fought over the Ark of the Covenant. They put in a warehouse, and they pan back, and suddenly you realize this warehouse is about 6 miles long. Now, to my knowledge, the IRS doesn't actually have one of those sort of warehouses. And some of the new provisions in the U.S. Congress will actually update their systems. But, this is a piece of information. This is tax hygiene. It's keeping your nose clean. Do not think that by saying nothing, it's a better situation. For reasons we're going to talk about in a second here. If you do have a permanent establishment in the U.S., you should be filing a full U.S. branch return. You're taxable in the U.S. That sounds bad. The good news is any U.S. federal income tax you pay, you can claim as a credit in Canada to offset your Canadian tax otherwise payable. So it's not like you're getting hammered. Now, the key case here is a new one. This is in 2021, Adams Challenge. This is a UK, I want to say shipping, but they had a ship that was in U.S. waters, and they never did anything. They had over $32 million of income, and the result being that by not filing a protective return, which they should have, they didn't have a permanent establishment. Or it's not apparent they had a permanent establishment, but they end up being taxed on their gross income as opposed to their net income. Now, that's a real gut punch because remember what happens there. They'll pay a whole whack of U.S. tax. Based on the tax rates at the point in time this occurred, which was in, 2014, the tax rate, top rate was 35%. And they paid about, $12 million in tax, something like that. And worse yet, remember I said that if you're subject to U.S. tax, you claim a credit in Canada, or in this case, the UK, that tax that you can claim as a credit is only based on the Canadian tax otherwise payable, or in this case, the U.S. tax. In other words, once it goes over Canadian tax rates, you're not getting any benefit from that. So you're really getting hammered on that.
Yeah. And I think a really big point here for Canadian companies is this non-discrimination argument. Do you want to discuss that?
Sure. Well, the non-discrimination argument basically says that the U.S. has to treat Canadian companies just like they would U.S. companies. And the taxpayer raised this in the court. Oh. The court threw it out because they basically said, you had an opportunity to fix this and you didn't do anything about it. In fact, the regulations, the IRS regulations provided extra time for people to do this, to get on side. So this was largely a lot of tax professionals were surprised by that result.
Yeah, I think it's rampant in Canada for tax advisors to say, oh, we always have this non-discrimination provision. You don't have to file.
Right.
This case says no.
Yeah. If in doubt, file a U.S. tax return. So one more slide here on this, and that is with regards to, I want to focus on this thing here, Form 5472. That sounds like an old police, was it car 54? I'm going back to the 60s again. Sorry about that. Flashbacks. But it may be required if you have a permanent establishment. The penalty is massive, $25,000 here. So this is a real killer. If you have a U.S. permanent establishment, you need to evaluate, do I have to file a 5472? There are regulations that say the IRS is going to go easy on you. Our experience has been at best mixed on that subject, that you're going to spend a lot of money with advisors to get that change, and you might not get the result you want or expect. The fact you've made that mistake in prior years, don't let that stop you from doing the same thing in future years, because if you don't file a tax return, there is no statute of limitations. And the IRS can request the assistance of Canada Revenue Agency to actually audit and collect on you. So, this is the big issue here. Don't be in a situation you're not filing tax returns.
Yeah, and I've seen this exposure, this $25K penalty, completely, be way farther than your actual tax liability. Right. And the IRS does not care. They don't care if you have $1 million of revenue. They don't care if you're running a loss. If you have a related party transaction, you do not file this form, it's automatic.
Right. Yeah. And it is being assessed automatically. It's a bad news situation. So let's flip to talk about state corporate income tax.
Okay. All right. So state corporate income tax, very, very, very different than federal income tax. So as Warren pointed out, under the treaty permanent establishment rules, it's very heavily kind of old economy type of things. A lot of times, do you have a presence in the U.S.? Do you have people in the U.S. doing things for you? Corporate income tax, very different. They've kind of changed the nexus, the taxability rules over time. Some of the things that are kind of tricky about state corporate income tax is that, of course, there's 50 states. And so not all states have a corporate income tax, but every state can have its own rules. And so when you're looking at your corporate income tax exposure, it becomes very tricky and time consuming to properly vet your exposures. In terms of tax rates, the tax rates for corporate income tax, much less than the federal tax rate. They generally go from 0 to 11.5%, but for the most part, it's a 5 to 8% band that I typically see. And again, just to kind of emphasize, the state income tax rules are different than the federal rules. And so I've had many, many clients who do not have a U.S. Permanent establishment, do not pay any federal tax, but at the state level, they wind up paying taxes. And in particular, California is a very good state at getting revenue.
It basically sucks income from outside its jurisdiction there. I mean, California says, they don't want 100% of nothing. In other words, if you're Exxon, you operate gas stations in California, say they operate at a loss. They say, no, we don't want 100% of nothing. We just want 0.0003% of your worldwide activities. And they do far better that way. And the risk is not unique to Exxon in California. It also applies for Canadian businesses. You say you're losing money in the U.S., but you're making money in Canada. And this will kind of go back to our discussion later on about structuring businesses too.
Yeah. Okay, so again, the important concept at state corporate income tax level is the nexus concept, which just means what kind of connections you have to have with the state in order for the state to tax you. And so traditionally, it's been physical presence. So when this is kind of the old school, old economy kind of rules, which I think I would argue the USPE rules still kind of, for the most part, kind of mirror.
This is the permanent establishment rules do that. Yeah. This is kind of the bricks and mortar thing again.
Yeah, exactly. Yeah. So, but the states got clever. They said, hey, we don't want to rely purely on physical presence. If you have a lot of connections and you're targeting our state for revenue, even if you're not physically present in our state, we're going to say you have nexus and we're going to tax you. And this, by the way, these rules kind of came into play, say, early 2000s. By the end of that decade, factor nexus came into play. And so again, California, sorry, I thought I had a technology problem there. California was one of the leading states in this regard. California came in and said, hey, if you have $500,000 of sales into California, you don't step a foot in the state, that will give you nexus. You have to file a tax return here, and you have to portion some of your income here for tax purposes. But they also have property and payroll, and those are more physical presence type of activities. So they're not quite as unique to the factor analysis. I think the sales is the big one. If you have sales, so again, this is online retailers. So we have a ton of clients that sell products into the US via their online platform, and purely sales will get them the taxable.
This is kind of the Shopify, Amazon, all those sort of things, which is where everybody's been at in the last year.
Yeah, or even your own online website, right?
Yeah.
So again, the nexus threshold in California, in the states in general, California in particular, are very, very low.
I mean, so if I do as little as I send, my trucks down to a state to deliver products, do I have nexus in those situations?
You could, but I would say this: it's kind of hard to make blanket statements again because every state is different.
Sure. And
there's all kinds of exceptions to physical presence nexus, and so it is a bit of a bee's nest in terms of trying to figure out kind of the different nexus.
So, like when you compare it against permanent establishment, though, this is a really low threshold. In other words, permanent establishment, you might not have a bricks and mortar test, you might have a dependent agent or a services threshold, but this is way under that. I mean, if I just kind of, am I crossing the state to do business and I leave that day, lots of people in Vancouver, Washington go to Oregon for the day, they're probably creating nexus, even though they don't have anything physical there.
Yeah, no, excellent point.
Yeah.
Okay, so where do we currently stand? And this is just a quick survey I did back in February. We still have 4 kind of states holding out. I say we have a physical presence standard. The thing is,
they're holding out because they're saying you have to have a physical presence to have nexus.
It's not even clear for because when you get to economic nexus, a lot of the economic nexus states roll into their facts and circumstances test whether you have a physical presence.
There's kind of a herd mentality here, isn't there, with this? Is a couple states jumped out and everybody followed.
Yeah, and frankly, one state, West Virginia, got their economic nexus statute approved way back in the early 2000s. And when the state saw that, it was a mass rush. And then 13 states have a factor-based nexus. Again, it kind of revolves around typically California's 500,000. There are states with lesser amounts. So in Washington, the state of Washington, we get a lot of clients going down. They don't technically have an income tax. They have a gross margins tax, but it's a factor-based nexus there. It's 100,000.
So, yeah, it's a really low threshold.
Yeah.
So states want your revenue.
Always. And they're smarter at getting it, I think is probably one of the big takeaways.
Yeah, they're expanding the definition to pull in more taxpayers.
Yeah.
And that includes Canadians.
Yeah. Okay, so that was corporate income tax. Kind of related to it, but very separate from it, is the sales tax. So the sales tax in the US is the big income generator at the state level. So 10 times the revenue is collected from the sales tax and the aggregate amongst the states versus the corporate income tax. And so thus you've seen a lot of the case law and a lot of the cases revolve around sales tax and when you have sales tax nexus. Sales tax is also far, far more complex in terms of administration than the corporate income tax. 11,000 jurisdictions.
Whoa, that's a lot of places. So that's, in British Columbia, pay the same rate of sales tax, regardless of where you go in the province. If you cross over the border to Washington State, there's a state rate, but then every county and some jurisdictions within counties have higher rates. So, there was, again, I keep going back to the other century here, and back in the old Kingdom days, but in CenturyLink, there's a different sales tax rate around those jurisdictions. It's typically government-funded sports facilities like football stadiums, things like that, trigger that an additional tax on top of the local tax. So you have three levels of tax, basically.
Yeah, yeah. And the sales tax rates, they vary widely. Some are very low. There's actually, I think, a handful of states that do not have a sales tax, but some states have a sales tax up to 13.5%. And again, to your point, California has a 7.25% sales tax rate. When you add in all those other jurisdictions, 9.5%.
So I know all the people in Alberta know the closest state that has no sales tax.
Yeah.
That's Montana.
Yeah.
And I think most British Columbians who have been down there know that too, that Oregon also does not have a sales tax. So those can be great shopping locations.
Yeah.
But look out for the states that do have sales tax if you're selling into those states.
And then perhaps the most important bullet point on this slide is joint and several liability. And so for state tax, sales tax purposes, this is really not a tax on the sellers. It's an obligation on the seller's part when they have nexus in the state to withhold and remit sales tax and remit it to the state government. But the clever bit that the states have done is said, hey, if you don't collect that tax from your purchasers, we're going to come after you for it. And we'll get the money from you instead of your 10,000 customers. Because they're not going to chase your 10,000 customers when they have one person they can go to get that sales tax revenue.
Yeah, we've dealt with some clients that have failed to collect and remit tax. And, fortunately, in one case, they were fairly expensive products that could be, tens of thousands of dollars a piece. And they went back to their clients, some of which paid, but others didn't. But especially if you're dealing in more lesser price goods, like it's almost impossible to go back and collect that sort of thing. That's where kind of ignoring these issues is just a disaster.
Yeah.
And particularly if you're going to sell your business, because a smart buyer will look and say, have you collected and remitted sales tax? So ignoring it is at your peril.
Yeah, exactly. I think, so I do quite a bit of tax due diligence, which is when you sell your company, the other person comes in and inspects your books and your exposures. This is probably the number one tax issue on tax due diligence. So again, big takeaway here, ignoring sales tax is expensive. And frankly, I think it's probably the biggest exposure for most Canadian companies, based on my experience. Okay, so again, we get back to nexus. When can a state subject a seller of goods to the obligation to withhold and remit the tax? This has a long history. Fortunately, in a way, it got simplified very much in 2018 by the case Wayfair. So this is a U.S. Supreme Court case, whole bunch of nuances around it. It's a fascinating case in terms of how it came up through the system and everything else. I'll spare the details.
So is this the same Wayfair that when I look for a new dresser for my bedroom pops up on the website?
It is.
It's the same Wayfair.
Yes,
so it's I think most of the listeners here know what Wayfair is.
Yeah.
So, and they steadfastly refused to collect sales tax.
Yeah.
So they really made a stand on this.
And the interesting thing too, again, it kind of goes to the whole history of this issue. They're an online retailer. And the sales tax issue really became ripe in the mid 2010s because the brick and mortar shops were losing revenue because they had to charge the sales tax. The Wayfairs, the Amazons, although Amazon did come into compliance a bit earlier, but all the online retailers that can pass on collecting sales tax were selling for a cheaper price.
So department stores and things like that were all collecting the sales tax, but Amazon and Wayfair weren't, and you can guess who was crying bloody murder on the whole thing. So
yeah, exactly. So Wayfair, again, when you get past all the nuance and there's technicalities and whatnot, it boils down to a very simple test. $100,000 of sales into the state, or is an important bit here, 200 transactions. So typically I will go right to the $100,000 sales when I'm helping clients kind of assess their exposures. You can't lose sight of the 200 transactions either. So,
Eric, we have lots of clients come to us and they've said, hey, we've been doing business, or we just started doing business in the US, or we've been doing it for 10 years and we've never done any of this stuff. What do they do?
yeah, I think the best thing you can do is kind of, again, collect their, hopefully, sales by state information. Let's see where you've sold your products. Hopefully you've been tracking it. And let's see what it looks like for the last 10 years. And then you start looking at sales volume as kind of the initial cut.
Kind of quantify the risk. Here's the biggest state, maybe here's the top 5 states, and then start to deal with it. One of the things they can do, particularly with sales tax, is most states will have a voluntary disclosure agreement that you can actually say, hey, we didn't collect sales tax for this period of time. We didn't remit the tax. There's a problem if you collect the tax and didn't remit it. That's a real problem.
That's the worst case scenario.
That's the worst case.
Yeah.
But if you didn't collect the tax at all, many states will actually say, we'll waive penalties because you came forward voluntarily, and we'll just have you remit sales tax the last 3 years or 4 years as opposed to the last 10 years. So that it's not going to feel good, but it's going to feel a lot worse if the state finds you and comes back and says, no, we want 20 years of sales tax.
Yeah.
So that's a proactive way to deal with that situation.
Okay. And again, the big takeaway here is this is a new standard and it's far, far lower. Before this, it was a physical presence standard.
So nexuses for states, permanent establishment for the federal government, and permanent establishment here, nexus down somewhere low, below the camera.
Yeah.
So it's a real low threshold.
And I would even say among the nexus requirements, I would say sales tax is even below corporate income tax.
Right, yeah.
Because there is more facts and circumstances.
So, I've had some clients say to me, gee, I thought because I'm a Canadian company, I'm not subject to sales tax in the U.S. states. And do you want to comment on that?
Well, I think, it's a complex issue. There's a lot of complex issues. That's one of the complex issues. I have had a lot of clients that said to me, how are they going to come after me? Right? I'm in Canada. Are they going to come across the border?
My experience is that California audits more in Canada than the U.S. federal government does, than the IRS does. So, there's certainly some sophisticated states. California is one of the classic examples. I mean, it's a larger state. I'd say the same thing about New York, too. Some smaller states, when you call in the morning and ask about a personal tax question in that state, and you call back in the afternoon and ask about a corporate question in the afternoon, you may get the same person. They're small. They don't have huge resources. But that's a pretty dangerous way of living.
Yes. Okay. And sales tax, we've got a hodgepodge of additional issues here. The sales tax analysis can be actually quite complex. There's all kinds of rules. There's this public law 86-272 we're not going into here that make it a pretty complex issue to kind of assess for clients. But in general, the sales tax applies to the sale of tangible personal property. So if you're not selling tangible personal property, you would generally not be assessed the tax. The problem, though, is each state has a list of enumerated services that they will subject to sales tax. I have a hard time finding rhyme and reason within a state as to what they're going to subject to sales tax, never mind across the various states. And so this is always a bit of a research project, no matter what you do. And again, you try to target your bigger states to kind of get focused on that. The big factor we see oftentimes is the resale exemption. So when we have clients who are selling wholesale, so they're selling to another business who will then turn around and sell to the end customer, that transaction is actually not subject to sales tax. However, you do need to get a resale exemption certificate, and we have a lot of clients who just don't do it. And that's a very, very common thing. That puts you at risk if you go to audit. So my number one thing with all clients that are in that kind of spectrum of having that resale exemption available, get the resale exemption. So it's critical.
One of the principal risks there is the they sell something to someone who they think is going to resell it, and that person decides to use it for their personal purposes. Yeah. There's no resale exemption there, so they're liable for the tax. And, if you sell widgets, maybe you're not that worried about that, but what if you're selling, very expensive, fixtures for, bathrooms and things like that, and you find out he's building a new house, your client. And you don't have control over those situations as to what actually gets resold and what doesn't. So, that's a really important factor there.
Yeah. And then for sales tax, there's also a bit of hodgepodge of exceptions.
What is hodgepodge?
An assortment, a variety of exceptions. And again, you're going to kind of have to check state by state. That said, if you have sales to the federal government, those are exempt from sales tax. Sales to some state governments will also be exempt, but again, that's on a state by state basis.
So in one state, you can sell to a hospital and that's free of sales tax. But if you sell to the fire department, it's taxable. And there's strange little rules that go between states as to what was the rationale there.
Yeah.
And you're not going to figure out, it's not uniform throughout the U.S.
Yeah, good luck.
When you say 11,000 taxing jurisdiction, that means potentially 11,000 different rules too.
Yeah. And then the big one is for like the online retailers, sales tax holidays. So the big one in the U.S. is the back to school. So when kids go back to school, if they're getting blue jeans, notebooks, backpacks, there's exceptions in many states. And so again, big takeaway, that resale certificate. If you have sales, wholesale sales, the resale certificate is key.
Now, what happens if someone says, they sell to what they think is a reseller and they refuse to, or they don't give them a resale certificate? What should the seller do? Yeah,
so I've never seen that, but I like your thought on this. I just collect the sales tax.
Yeah, if they're not going to give you a resale certificate, what you're going to do is say, well, I have to withhold the sales tax. And they'll give you that resale certificate pretty fast, or they may know that it's not going to be resold. And so, force their hand. One thing I do find is this, we provide these services and we help clients do that. But the buyer of your product is probably very aware of what their tax position is. In other words, should sales tax be withheld at all? So I always tell clients first, if you don't know if it's taxable in that state, tell them you're collecting sales tax. And if they say, no, we're not taxable, say, give us evidence as to why it's not taxable. And they'll usually produce for you saying, here's the section of the state code that says, the sale of fishing rods with bobbers on them is exempt from sales tax, but fishing rods without bobbers is taxable. So there's, odd rules like that. So
that's a great example, though. It gets that.
The bobbers?
Yeah, it gets weird. It gets weird at the state level. And then one last thing I would say is on the sales tax exemptions, most states do have those online. And there is a uniform exemption that's good for 30 plus states. And so you can do a Google search and get these resale exemption certificates.
Excellent. Use of contractors in the U.S. So we've talked about U.S. federal income tax. We've talked about state sales tax as an income tax. Now we'll talk about what happens when you use contractors in the U.S. Contractors may create a permanent establishment in the U.S. We talked about that. If they conclude contracts in the U.S., you could have a U.S. federal income tax obligation. They could also be employees. Now, this is a real hot button issue here, is because if they're employees, and it's not what you call them, it's actually what they are under federal law, then you're obligated to collect and remit their income tax on payments to them. If they do not pay their tax, you're liable. Plus, you have penalties for failing to withhold. So this can get expensive real fast again. This is a significant issue. So it's going to create payroll obligations. Dependent agent, we talked about this before. They could be an employee or a contractor. State and corporate tax obligations, those can both come from the use of contractors. For example, if you had a company that had manufactured products in Canada, but had a contractor in the US that installed them, and it was all part of the same contract, the Canadian company would be liable for the state sales tax and corporate income tax, even though they didn't have a permanent establishment. So you use the words facts and circumstance a few times. Again, it's a facts and circumstances driven thing, but if you're using contractors in the US, whether they're installers, whether they're collecting bad debts from your clients, whether they're salespeople, manufacturing reps, all those things can trigger obligations associated with it. And you have to evaluate, how do they impact our business, and do they create a filing obligation? Now, remember, the right thing to do here, the goal here is to maximize your business results in the US. But if you let your tax obligations get out of hand, you might not make any money and still have a whole boatload of taxes and or penalties that come on board. So you need to be able to manage both of these things. I like the way you talked about, Eric, kind of quantifying risk and evaluating which is the most important thing to do here. And contractors fit in that category. So they can trigger tax obligations here for you.
Yeah, and I think I've seen most often the case where Canadian company is being successful building its business, no U.S. footprint, and then it starts hiring sales folks. And inevitably, the first time you start getting these stories, it's, oh, he's just a contractor.
Right.
And you're like, okay, but he only works for you. You have sales revenue targets for him. And then we get into he's really not.
Or worse yet, they hire two people, and one's an employee and the other's a contractor, but they do identical things. So there's a bunch of situations. Contractors are a confusing area for a lot of people. Interesting, the law associated with what's a contractor and what's an employee between Canada and US is very, very similar. Yeah. So there's not a big difference there. Substance-based, exactly. Yeah. So ownership of U.S. business. How do you do business things? We talked about the tax implications, but how do we actually structure this? Again, we said earlier, any person or entity can do business in the U.S. You don't have to create a separate entity to do it. You don't have to have a U.S. entity to do it. And really, there's two principal reasons to have an entity. One is to limit liability. If you're a shareholder of General Motors and you buy their stock for $100 and they build a car that explodes and kills everybody inside the car and the people around it, and there's massive liabilities associated with it, you're only at risk for your $100 that you invested. They can't take your house, they can't take your car, they can't take anything else. You're just limited to that liability. So that's where entities are really effective. Secondly, is they can be used to defer tax. Now, there's a real difference between Canada and the U.S. on this subject. The U.S. also has entities that limit liability, but there's actually a bias towards ones that limit liability but don't defer tax. And we'll talk about this in a second, but things like partnerships and limited liabilities, people in the U.S. want to stream income to them. Conversely, in Canada, because we have relatively high personal tax rates, is we incorporate everything, say, no, don't give me the income. Keep it away from me. I don't want to pay tax on that personally. I'll pay it in the corporation at more attractive rates. So there's a bunch of alternatives here in terms of ownership of different businesses. And at the top of our list, we have limited liability company, only because it's the one you generally don't want to use if you're a Canadian investor in the U.S. or Canadian doing business in the U.S. Now, there are uses for limited liability companies, but typically we see LLCs show up because someone's been reading stuff on Google. They've been doing their own tax research, which is great and admirable. I totally respect you for doing that. Worse yet, you go down to a CPA or a lawyer in the U.S. or some other business person and say, how should I do business? And they'll tell you, all our clients use LLCs. Or almost all our clients use LLCs. That must be the way to do business. They are exactly right. All their clients do use LLCs, but you're not one of their clients. You're different than their clients because you're from Canada. Now, the problem with Canadians is you have a double tax risk. And the simple answer is Canada and the US look at the same entity and they come to different conclusions of what it is and how it's taxed. So LLCs, you got to be extraordinarily careful with.
So if we have, I got two fact patterns for you. So we have a Canadian client goes down, he's got some US business partners. And there's 10 of them, 20 of them. They say, we're doing an LLC. Is there a way you can fix it for the Canadian client?
Well, there's two ways to fix it. And even if you're a nominal partner thing, I'd say the first way to fix it is this. I'd say you go to those same guys, and there's some other issues here that may be in play depending on what type of business you're in, but saying, hey, if we can convert this from being a LLC to being a partnership, even a limited partnership, and there's some issues associated with limited partnerships, I'll pay for all the costs of that because the alternative is generally more expensive. So the alternative is saying, if you're investing in an LLC and you can't change that structure, is to put a U.S. corporation in place to own the LLC and then have a Canadian corporation to own the U.S. corporation. You can say anytime you create an entity, you're creating costs. And so, it better not be a $5,000 investment because you're going to pay way more in your cost to comply than you'll ever benefit from that investment, unless it's, I guess, GameStop shares or something like that, or, Apple. But your threshold of investment has to be higher to do that, to have that make sense.
And then what if you have a Canadian person, sole owner of the LLC? Could they check the box? Does that help anything? Yeah,
they could check the box. I mean, candidly, most of the time, a lot of times people come to us saying, hey, I just formed an LLC. What do I do with it? Yeah. So I say, well, probably you want to get rid of it. Now, one of the things they can do is, as you said, check the box. That sounds very sophisticated, doesn't it? There's actually a one-page form that the IRS publishes that you can literally check the box, and magically the LLC is transformed into being, for U.S. federal income tax purposes, a corporation. And because it's a corporation for U.S. federal income tax purposes, and it also happens to be a corporation for Canadian tax purposes, some of the issues have been knocked out. But generally, we do not encourage people to do business directly with a U.S. corporation from Canada. They typically want to have a Canadian corporation that owns a U.S. subsidiary. So, those are some of the choices people get to make. One of the other alternatives people come to saying, what about an S corporation? I hear all about S corporations because when I went to that lawyer in the U.S. or the CPA, he said, well, if my clients aren't using LLCs, they're using S corporations. S corporations are creatures of U.S. tax law, and they're going to be problematic for you. Aside from the fact that it's generally you have to be a U.S. person to be a shareholder. There are some exceptions, and you might fit into some of those exceptions, but it's generally not a desirable category to get into unless you have to be a U.S. citizen living in Canada. That's where, and you're going to do business in the U.S. An S corporation make a lot of sense there. Corporations, the big question is there going to be a U.S. permanent establishment? If there's not going to be a U.S. permanent establishment, use a Canadian corporation. You won't have to pay any U.S. federal income tax. You may still have a state corporate income tax liability or sales tax obligations, but you won't have any U.S. federal income tax obligation, aside from you're going to file that protective return, that treaty disclosure return. If you do have, or you will have, a U.S. permanent establishment, generally you're going to want to use a U.S. corporation. Now, typically that structure ends up being, here's you, the individual, here's your Canadian corporation, there's the border, and you end up with the U.S. subsidiary under the Canadian corporation. That gives you the most efficient tax structure. But the last line, no one size fits all, because there's lots of reasons why you might choose to use a partnership. I love partnerships. They're very flexible entities. Partnerships are easy to get into, easy to get out of. Corporations are like, for those people who are crab fishers or lobster, they're like crab pots. They're easy to get into. They're tough to get out of. So, corporations create problems for you. So no one size fits all in these categories.
Okay.
Questions? So we're going to send you a survey as soon as this session's over. We said we'd shut this off at 10 o'clock, and we're moving up on that now. But please take the survey. Tell us how we can improve. Hodgepodge, was it?
Hodgepodge.
Yeah, hodgepodge. Yeah, that's the word of the day.
I think it's a good one.
I'm with you on that. Topics you'd like us to cover, and we're going to spend more time for questions. Now, if you need to go, or you're tired of listening to us, or one or the other, you're welcome to click off at any point in time here. But we'll take questions now. And I know Catherine has those, but before, if you click off, thank you for joining us here. We've enjoyed ourselves, and I hope you find tax just as interesting and unusual as we do. Catherine, any questions for us?
Yeah, sure. We've had some questions. First one. So with regards to sales threshold in the States for sales and use tax, does it have to be $100,000 of sales in the same state for Eric?
Sorry, in the same state?
Yeah.
Yeah, so that is generally the prevailing threshold. Now, there's some states, and again, no rhyme or reason to it, have chosen a higher threshold. So again, you have to check on a state-by-state basis. There's some states with $250,000. California has a $500,000 factor test. And I believe New York, it might be $1 million in New York.
But what if I had employees in that state and I had lower than that threshold?
Yeah, so then you get back to, is it economic, well, you probably have physical presence.
Right.
So again, we kind of, all these kind of things layer on top of each other. That would probably give you nexus in the state, so regardless of your sale.
If you've got salespeople crisscrossing all the states, stuff like that, you're probably picking up sales tax nexus anywhere one of those jurisdictions, even though you don't meet that 100,000 threshold. Now, again, as you've already said, it depends on which state you're talking about.
Yeah.
So there's not one rule that says, here's what happens in all those states. So what states are we talking about? I presume they didn't ask which state they are, and I don't know we're in a position to answer that question on the fly.
No.
If you say Rhode Island, we're not answering.
So next question. So when dual citizens immigrate back to Canada with an LLC that is treated as a C Corp, what is the tax treatment on winding up the LLC? And then what is the sourcing of the income for foreign tax credit purposes? So two questions in one shot.
Yeah, this is a loaded question.
Tax professional question.
Yeah, I mean, this requires more attention here, but I mean, generally what happens when a corporation is wound up, because we're saying it's treated as a corporate, it's going to be treated as a distribution. And for US tax purposes, it's a capital gain. Typically for Canadian purposes, it ends up being a dividend. What you'd really want to do in situations like this is either before the move or immediately after the move, change the structure of the entity. And like I said, partnerships are a lot more flexible than corporations. So some of the things ideally is pre-move planning, and some will be after. I don't know if you have any other comments on that.
No.
That's so fact dependent there that it's difficult to give an answer without knowing more facts there.
Yeah.
Next, do you have an example of online sales sites accumulating resale exemption certificates?
Online sites.
So like Amazon, what's Amazon FBA?
Yeah.
For sale by Amazon.
Yeah. Well, I think in that case, typically there's Amazon Marketplace legislation. This is another kind of complex nuance of sales tax rules. They would likely have Amazon stand in your place and collect sales tax for you if it was to the end retailers, which through Amazon it would be, right? So
remember that the resale certificate only applies if you're selling to a reseller. So, if one can say this, I would suggest at least the bulk of internet sales are to end users. That's not exclusively true. A resale certificate would not be applicable there in any event. So you'd have to be selling, this is me selling my specialized paint mixer to Home Depot, which is going to resell to other people. In that case, I'd want to get a resale certificate from Home Depot. If I was selling that through Amazon, then the presumption here is Amazon could obtain that for me.
Yeah.
Because oftentimes I won't have the connection with that customer.
All right. Next. So we're a BC corporation that has been investing in various U.S. funds that involve real estate projects in about 5 states. And then we would normally receive 5 state K1s. Do we need to file in each state that we receive a K1?
Do you want that one?
Sure. Yeah, you do have a filing obligation each state. And you have a filing obligation federally as well. And the rules will apply equally on both of them here, is that you want to file a tax return, even if you say, well, I lost money. And this is a common frame. People say, well, I got this K1, but I lost money, so I didn't file a tax return there. Well, by not filing a tax return, there's 2 bad things happen. One is you never get the benefit of that loss because you didn't file a tax return for that year. But more seriously, what they say is, well, I had a loss. I lost $5,000 in that investment. And it said on that K1, I think it's line 1, it says 5,000, it was in brackets, I lost $5,000. I said, yeah, that's a little bit misleading. Actually, what happened on your share, you lost, you had $1 million of sales revenue, and you had $1,005,000 of expenses. And potentially the risk here is if you don't file a tax return, your deductions are disallowed, and we're back into the Adams challenge case we talked about earlier, and you're taxed on your gross income. And typically, not exclusively, but typically a K1, if there's from a business active in the US, is typically going to be coming from a permanent establishment. And that's going to mean that you as a partner have a permanent establishment in the US. So, you've got a filing obligation and have that exposure.
Okay. We have more questions here. So I am a U.S. citizen living in Squamish, and you mentioned S corporation can only be used by U.S. persons. So should I use an S corporation to provide consulting services remotely to a California tech startup company?
Oh, you want to pass it to me?
I'll go back to you. Yeah.
So, again, this is highly fact dependent. S corporations are good for U.S. persons doing business in the U.S. to be subject to U.S. tax, because a U.S. corporation doing business in the U.S. is going to pay tax, is going to have what's called a subpart F problem. In other words, they're going to be attributed that income even though they didn't get it personally. It went to the corporation. An S corporation allows the Canadian and U.S. tax implications to be matched up. And for U.S. citizens, that's one of your biggest issues, is matching results in both Canada and the U.S. And then you do that by making an election under the Canada-U.S. tax treaty to elect to have the S corporation treated as a flow-through entity for Canadian purposes. So thanks very much for the questions, Catherine. We're going to wind that up right now, but thank you for attending. Any final comments?
No, this was great.
It was a hodgepodge. No. It was good. Thanks very much, and we'll look forward to having you at our next webinar.